welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The main objective is to get a deal that does not disrupt the supply chain. You know, the tariffs that we're putting on China, and then, of course, you know, China's response, which is to deny us potentially access to the things that we need, particularly manufacturers. You know, that's a really dangerous combination with the Trump administration, because prices will go up and then there'll be sort of blocks or, you know, scarcity in the supply chain.
Basically, everybody thinks that all the previews suggest very little on Apple Intelligence and Siri. And of course, that's where all the market buzz is. Everybody has been talking about AI. You guys have been talking about it for the last few minutes. I've been listening. I mean, that's what everything's about. So there's definitely going to be some disappointment, I think, from the hardcore AI folks and some of the hardcore Apple fans.
What's so striking about this is that this combined company was formed a little over 3 years ago. It has a ton of debt. It actually took on a lot more debt in the process of that combination. And nowhere in this announcement did we really hear much about the declines that we've seen overall for the network side of the business and the television side of the business. So I'm curious how this is going to play out in the public markets here and what shareholders are really going to look at when they're evaluating these two separate businesses.
We got 1 hour to go until the market close. Taking a look at the major averages here today, there is definitely a divergence today. All three major averages are up, but the Dow's doing a lot better than the other two. It's up 1.2%, almost 180 points. The S&P 500, in contrast, only up a third of 1%, and the Nasdaq's up about a half of 1%.
Well, the S&P 500, I mean, that is knocking right on that February peak. So do we keep moving higher? If we do move higher, what will that depend on? We have some smart strategists we'll talk about that with. A couple other themes today. I mean, U.S.-China, of course, that kicked off those trade talks in London. I did see reports, Julie, those were expected to continue into the UK evening and maybe restart tomorrow. Obviously, investors are watching that closely, whether you get any kind of headlines out of that. Finally, big tech is in focus today, too. Apple with its big software show, WWDC. Heading into that, we know expectations were modest. They were pretty tempered. We talked about that. The stock is down here. It's down about 20% this year. And we'll talk to some analysts today about that move and what they think can get investors just excited about this name again.
Yeah, I also want to take a deeper dive into the Dow because, as I said, it is up more than the other major averages today. Now, you got that big red Apple in the middle of it here, but you have other stocks within big tech that are also in the Dow doing well. Amazon notably up 2%, Microsoft and Nvidia are higher, and I'm going to equal weight it here so we can get a better look. Boeing shares rising today, perhaps on the China talks and some hopes that, you know, we just saw China put in a big order for Airbus. So if there is indeed some progress on talks, could that mean some things for Boeing? Caterpillar, likewise, IBM, which we're going to dig into later at the show, trading at a record today. Then you see Disney also performing well. So it's interesting to see the Dow in particular, you know, outperforming the other major averages. Let's get more on what's going on with trade here, because the U.S. and China did restart trade talks in London on Monday, aiming to ease tensions over rare earths and tech. For more on the latest trade talk, we've got Yahoo Finance's Ben Worschel, who's been following all of it closely. So what do we know about progress, about what they were talking about, and what happens next?
Yeah. Good afternoon, Julie. So it is well into the evening there in London right now, and these talks do still appear to be going on between the two sides. The Treasury Secretary Scott Bessent is leading on the American side, and the overall landscape here is that this is. The expectations setting from both sides is for a sort of limited agreement coming out of this. These talks may go into tomorrow, but we know that the top issues on the table from each side, which is on the U.S. side, it is rare earth minerals. This is what the Trump administration has been claiming the Chinese have been cheating on since the agreement was reached about 30 days ago to pause the tariffs. And then from the Chinese side is a focus on semiconductors and export controls more broadly. And what we're sort of expecting from this is that they're trying to get confirmation and more concrete details on these two issues, which President Trump and Xi Jinping discussed last week. As Kevin Hassett said today on CNBC, they literally just want handshakes. They just want to get these deals done, and then they can work on the other stuff. And what that leaves off the table, of course, is all these other issues on the table between the U.S. and China. We're not expecting a lot of progress on those. Any sort of broader trade agreement between the U.S. and China will kind of go ahead, as well as the tariff issue, which is the big one, obviously, for investors. And we have about 60 more days on a 90-day pause between the U.S. and China on those sky-high tariffs that they agreed to. So we're trying what the administration wants here is a limited agreement on these things so that they can kind of restart the previously stalled talks on other things while tariffs are going forward. President Trump is actually speaking this hour at a different event, so we may have more insight on this. But that's the kind of landscape we know right now.
Who is your sense, Ben, as somebody who's following these trade talks so closely, who is your sense between the U.S. and China of who has the leverage here?
I think it's the rare earth thing is the thing that's clearly spurred the problem here right now, and that is China's major leverage. Rare earths are the mineral that kind of drives modern society, modern technology, and the reserves and both the reserves and the refining capacity are in China, so they have the clear leverage on that point. The question basically is, can the Trump administration bring enough leverage points? And the semiconductors is a significant one to do this. But the rare earths is clearly the driving issue here, and it's the one that has the sort of widest range of economic implications if that really goes sideways. Although we don't have any evidence that that's happening yet.
Ben, thank you, sir. Appreciate it.
Sure thing.
Well, stocks edging higher as we count down to the closing bell. For more on the latest moves and how investors are positioning themselves amid market volatility, let's welcome in here Phil Orlando, Federated Hermes Chief Market Strategist. Phil, it is good to see you. So we were just talking there, Phil, to our colleague Ben Werschkel about the U.S.-China trade talks kicking off in London. I'm curious, Phil, how you think through these trade tensions and trade talks as a strategist.
So our view has been that the whole trade situation, all of the noise and the nonsense and the chaos, was merely a negotiating tactic by the administration to try to bring their trade partners to the table and try to negotiate some better terms. Remember, the last year we experienced a $1.2 trillion balance of goods deficit on trade that cost us about a 0.5 percentage point of GDP. This year, we're tracking at about a $1.6 trillion deficit, cost us about 2/3 of a percentage point of GDP. I think the administration's looking at that saying, well, wait a second, our overriding economic goal from a fiscal policy standpoint is to generate sustainably 3% or more GDP growth, and we're losing a 0.5 point, 0.75 of a point, whatever, to trade. Why don't we figure out a way to sort of neutralize this deficit, or maybe even turn it into a surplus, and that will put us that much ahead of the game in terms of achieving our overriding economic objectives. So I think the progress that we've made with the UK and China and, presumably a dozen or so of our other trading partners that we're talking to behind the scenes, I think this is exactly what the administration was hoping for in terms of improving the prospects for economic growth.
At this point, Phil, does the market even care what these agreements look like? You say that this was a negotiating tactic to get a better agreement. Does it actually matter if we get better agreements, or does it just matter that we haven't imposed, really onerous tariffs that are going to freeze economic activity?
Well, I think the answer to the question, Julie, is both. First part of the answer is, okay, the fact that we're talking and we might get a handshake out of this is a lot better than where we were on Liberation Day a couple of months ago. So for that, the stock market's up 25% in the space of the last couple of months. When the dust settles on this, we'd love to have better, lower negotiated tariff levels that will produce better free trade with better economic growth on both sides of the equation. So we've made a positive intermediate step. I don't know if the market will be completely happy if this was the end game, but we're in a lot better shape today than we were a couple of months ago.
And speaking of that, Phil, I'm looking at the SPX here, the S&P 500. You're knocking right on that February peak, Phil. When you talk to your clients, are you telling them, listen, we're going to move higher from here, near to intermediate term? And what does that depend on, Phil?
So we're not changing our view. We thought the S&P 500 would get up to the 6,500 level this year and 7,000 by the end of next year. So we're delighted that we've seen this 25% rebound, and we're encouraging clients to hang on. We think things are going to go higher. We think the economy is not going into recession. We think corporate earnings are going to continue to grind higher. If we're right that inflation remains relatively benign and that the labor market is loose, is weakening a little bit here, that suggests that we may see a couple of rate cuts from the Federal Reserve at the back end of the year. Lower interest rates likely will result in a slight expansion of price earnings ratios, and that represents the base case for why we think stocks ought to be higher over the next 18 months or so.
What could go wrong with that scenario?
Well, there are many things. We started this conversation talking about the progress we're making on trade. Suppose these discussions blow up, by historic proportions, and we don't have a trade deal, and we're back to where we were, on Liberation Day, and that's certainly a problem. Suppose the Federal Reserve decides that it doesn't like what it sees. It needs more information on tariffs, and it opts not to cut interest rates later in the year. Maybe they turn and hike interest rates preemptively because they think that the destruction of the tariff situation is going to result in higher inflation, and the Fed is going to focus on trying to bring higher inflation down rather than cater to the fact that the labor market is weakening. So there's any number of factors, among our assumptions that could go wrong. But at least for the last couple of months, things have been, falling into place and moving in the right direction.
You mentioned the Fed there, Phil. Now, President Trump has made it clear, Phil, what he wants. He's pressing the Fed. You should be cutting. You should be cutting by a full point. Is the president right?
The president should stick to his knitting and not try to bully pulpit the Fed into cutting interest rates. If the administration does the right thing in terms of getting favorable negotiated tariffs deals, continuing to keep the economy growing and out of recession, keeping inflation at moderate levels. Right now, the upper band of the funds rate is at 4.5%. The annualized nominal CPI rate is at 2.3%. You can drive a truck through that spread. The data suggests that the Federal Reserve has plenty of room to take the funds rate down from 4.5% to 3%, looking out over the next, say, 12 to 24 months. If the administration does its job, the Federal Reserve, in our view, will certainly be able to accommodate and bring interest rates down starting later this year.
Phil, thanks. Good to see you.
Julie, thank you so much for having me on.
We're just getting started here on Market Domination. Coming up, Apple's Worldwide Developers Conference kicking off Monday. We'll get you out to Cupertino, California on the other side to check in on the latest from the tech giant. Plus, President Trump's budget bill casting a cloud of uncertainty over clean energy. We'll hear from the CEO of Sunrun later in the hour. And Warner Brothers Discovery planning to split into two independent publicly traded companies. So what does that mean for investors? We'll be joined by an analyst to break down the moves and what comes next. Stick around, much more Market Domination still to come.
Apple's Worldwide Developers Conference kicking off today. Let's get out to Cupertino, California for more with Yahoo Finance's Dan Howley.
Yeah, Josh, we're here at Cupertino's or Apple's campus in Cupertino, California. They just wrapped up their WWDC keynote where Tim Cook took the stage. The big announcements out of the show: a whole new redesign for the operating systems that support Apple's products. That's iOS, which runs the iPhone, Mac OS, iPad OS, Watch OS. They're all getting a new design that resembles kind of glass. Now, this is going to be kind of the thing that Apple is leaning on to help push sales of its phones when it comes out. They've renamed all of their operating systems. Now it's no longer iOS 19 or 18. It's going to be iOS 26 based on the year that it's mostly out. It'll come out later this year, but it'll mostly be out in 2026. One of the other big announcements is that the iPad now is actually truly useful as a laptop replacement. So that's a huge change for Apple. The one downside, though, is that there were very few major AI updates. Now, they wove Apple Intelligence, their AI platform, throughout the presentation, but didn't really give us a huge splashy announcement like we saw at Google I/O or Microsoft's Build. Now, they mentioned Siri and how they're still working on that, trying to update that and bring it to life, the more personalized Siri that's got generative AI power, but we didn't see that. They did have some generative AI announcements that were interesting, but it'll be, we'll have to see what Wall Street says as they digest the news and kind of take into account the fact that they're still not ready for that next generation Siri yet.
Thank you, Dan. Appreciate it. Well, Apple kicking off its Worldwide Developers Conference today in California. Tim Cook and company trying to address the challenges it's facing in the AI race. For more, we're bringing in now Ben Beharin, CEO and Principal Analyst at Creative Strategies. Ben, it is great to see you as always. So Apple's big software show, Ben, it kicked off today. You were listening. What did you make of what you heard, Ben? Did you hear anything that surprised you?
Yeah, I mean, I think the biggest surprise, obviously, as you guys pointed out, was the iPad update. I think a lot of people have been looking for what we'll just say more pro-level features to the iPad. So that's things around multitasking, some of the better file management. I mean, candidly, I think people wanted iPad to be more like a Mac, and I think that's really what they did. Now you've got this sort of multimodal opportunity, use the best of iPad, have some of those Mac features built in to do a lot more productivity or even heavy work versus light work, right? Which has sort of been the debate. Wasn't really surprised about any of the larger UI schemes. And I think there was just more clarity here around where Apple's priorities are in terms of eliminating friction, making these features more helpful. And I thought, while yes, not really a whole lot around kind of the front end of AI, so like how you would interact with it, there's a lot of back end of AI that's happening from Apple. I think they've been talking about this for years, just not saying it's something like Apple Intelligence. And at a fundamental level, like exposing what's useful or making AI useful at a system level, and then for developers, is kind of the theme where I think we're now at that foundation that they'll build upon that type of a strategy, from a back end at a system level.
Ben, all of this sounds pretty incremental, right? Not necessarily retail customer facing, to your point. Does this move the needle at all in terms of a refresh cycle?
I mean, I think the refresh cycle is just going to stay standard like it is. I don't think we're going to see a fundamental change to any of those forecasts or any of this kind of pull in. Again, I think the dynamic between iPad as a productivity device, even its opportunities in enterprise, they obviously sell, north of 10 million, plus iPads per quarter. That's a good unit volume. I think, expanding that, making it more attractive across the vector will be super interesting to see when it comes to hardware sales. But we're still not expecting, and I didn't expect any of this to change our opinion of, just the refresh cycle staying as it is. iPhone's relatively flat. We don't really see that changing. And to be honest, like we've talked about before, I'm not sure we ever see kind of this upgrade, super cycle like we have before, AI or not.
So what Ben, if you don't get that super cycle, what drives this stock higher? What gets investors excited?
I mean, I think there's a combination of the device categories that they're in, right? So I think looking at other areas, I've always been bullish on Mac and the enterprise. I think they have a lot of upside there. I'm now more, bullish on iPad's opportunity, or iPad Pro, which was a small volume of overall iPad shipments to go into that Pro category. So I think there's ancillary hardware. I think there comes a time, right, we're just not there yet, where they're setting the stage and this foundation leads to what they will do with a AR, VR, whatever we want to call that category, smart AI glasses. We're just not there yet. But that's why I come back to the foundation that's being laid for the next 10 years, both software and hardware. And I think you're seeing some of those seeds right now be planted in these new versions of the software for the platforms.
I've heard, Ben, some analysts make the following argument. I'm just curious to get your take on it. I think it was the team at Evercore who said this, they were making the case that, listen, AI, basically Apple's playing a different AI game, was their point. And to paraphrase, their argument was, listen, Apple is not spending billions and billions and billions on AI CapEx. That's the Meta, Microsoft, Google way to approach this. Apple, they said, it's a different strategy. They stay capital light and then charging a fee to model providers for access to all those iOS users. What do you make of that?
Yeah, I mean, I think that falls into the, services revenue part of this camp. I mean, I think if you just look at, again, they're going to have a partner. And I think when you look at the things they did around iOS here, you see a lot more ChatGPT integration, meaning where they hand off a query or a natural language request into, a broader LLM, in this case, ChatGPT. That's still expensive, whether it's them or whether it's Google. It's not, free or cheap to do that. So I do think they'll have some monetization opportunities where they can share in those revenues across vendor. And it does feel right now like let's call this AI as a service, that them plus ChatGPT presents an opportunity. So I can see that as, again, a services revenue kind of increase, again, bringing more of that functionality on the back end to make this more useful, right? Make AI useful, not necessarily just about a chatbot, which is sort of what gets talked about or lumped into AI today.
Final question, Ben. This big software show, it's aimed at developers, those millions and millions of Apple developers all around the world. And the point is, hey, you all should stay excited about building those killer apps and experiences for the Apple ecosystem. Do you think Apple did a good job of that today, convincing those developers to, yes, stay excited?
Yeah, I mean, I think the energy was good. Obviously what gets lost in the keynote, which we saw here in person, was some of the developer energy around some of the announcements. There was a good positive reaction to, the announcement that Apple was going to open up its foundational models to developers, something I thought would happen last year, but, has happened this year, which means they can now take advantage of private cloud compute, some of those foundational models, and build them back into their apps, which again is back to my point of enabling this at a back end so that developers can start to make AI useful using some of these techniques of on-device that Apple is exposing. And I think that's still a strong story. But developer reaction to that was positive. And again, just being here, you can still sense a lot of excitement, a lot of developer energy. They want to start making these new classifications of apps that are going to start to use AI, again, for these helpful, anticipatory, beneficial experiences to their software. So I sense it. I don't sense that that's waning in any way. And I think they're all excited about, what comes next in software development. And I think they're excited about Apple's platforms to do that.
Ben, always great to see you and to have you on the show. Thank you, sir. President Trump's budget bill casting a cloud of uncertainty for clean energy. We're going to hear from the CEO of Sunrun later in the hour. Stick around. Much more market domination. That's still to come.
President Trump's budget bill casting a cloud of uncertainty over clean energy. Now, in its current form, the budget bill working its way through the Senate eliminates tax credits for clean energy. Some companies in the sector are already feeling the sting under the Trump administration. For example, U.S. residential solar provider Sunnova Energy, the latest in the industry to file for bankruptcy amid mounting debt and weakening demand in that case. For more on the state of renewable energy, let's bring in Mary Powell, CEO of Sunrun. It's the largest independent residential solar installer. Mary, it's good to see you again, and really appreciate you joining us to give us some perspective on this situation. So how are you preparing for the possibility that indeed we'll see the expiration of some of these tax credits in this bill? I guess I should ask, first of all, do you think that indeed will happen? Do you think that will end up being a part of the finished bill?
Well, it's wonderful to chat with you about this very important topic. First and foremost, what we're doing at Sunrun is very differentiated. So I think, as you may recall when we last spoke, we made a really sharp pivot to being a storage company, to being a company that is about installing batteries all across America. In fact, we're the leading provider of batteries and storage to customers. So in that, it really transforms Sunrun into a significant generating company, is the easiest way to think about us. And so we are very much aligned with the president's agenda around achieving energy dominance, having a lot of American-made energy, and providing resources for customers to also avoid those sharp utility rate increases. So as we're making sure that our message is heard and that it's understood, that absolutely increases my confidence that as this bill makes its way through the process, very much what we do is going to be an important part of the mix.
So Mary, if what comes out of the Senate, though, ultimately is as tough as what came out of the House when it comes to these tax credits, what does that mean for Sunrun, and what is your strategy to navigate that?
Well, Sunrun, again, as you may have heard on our last earnings call, as I said, Sunrun's outlook is bright. Yes, the current situation makes it a bit murkier. And that's why, again, I feel like as it is understood what we do for America around energy capacity, meeting the energy capacity needs of the future, we all know there is a hockey stick of demand. We all know that there is a significant race around AI and ensuring that American energy can play a role in that AI race. And so what we do is critical to that. Back to your question on what we do at Sunrun is we always use any opportunity to be continuing to navigate and figure out how to position ourselves no matter what the outcome. But again, the outcome to me will ultimately be tied to the president's agenda. And the president's agenda is about ensuring that America can win in dominating the energy landscape of the future. And Sunrun is very much contributing to that.
Do you think, though, that dominating the energy future, that the best path there, I mean, you know, the administration has complained that past administrations disadvantaged industries, including the coal industry and other fossil fuels, for example. Do you think that this administration is now disadvantaging the renewable energy to the detriment of that goal of energy dominance?
Well, what I would say is what we do, again, is a bit different in the space that we're in. So what we do is we are about bringing energy capacity that can be used by the grid. As an example, which is not the case with all forms of energy. So what we do is we create dispatchable energy that can be used by the grid. We have about 75,000 customers participating in programs right now to support the grid with their energy, because again, we are a company that is about providing batteries and storage with solar, so that, again, the customer can have a more resilient, affordable future, but that we can also be an important part of the resource for the grid of the future.
Mary, just to make sure I understand the business, you're still putting panels on people's homes, correct, as part of the battery system, right?
Exactly.
So won't tax credits to install those panels potentially go away? And what effect will that have on installation rates?
Well, there would be, yes. I mean, what is proposed right now is a phase down. It's moved into the Senate, as we all know, and we all expect there to be changes in the Senate. But yes, right now, it would impact what we do. But again, what we do is so based on storage and batteries with solar that it puts us in a very different position in this conversation and in what we can provide in the future and how we monetize that value for our customers and for Sunrun.
Mary, before Trump returned to the White House, another challenge I know for the industry was, relatively high borrowing costs and what that meant for demand. Talk to me about that dynamic and how you're navigating it.
Excuse me, the demand
for high borrowing costs and the challenge that.
I mean, candidly, we've been in that situation and we have navigated it very well. Sunrun not only made a sharp pivot to storage and to batteries, but we also made a really important change in our business to accommodate what was happening with rising interest rates. So again, as I said on our last call, we're doing very well. Our outlook is very bright for the business. And again, we feel very confident that we play a very important role in helping achieve the president's agenda around meeting energy capacity demands of the future and the dominance that we can achieve.
If the tax credit roll-off does remain in the bill, do you expect that maybe some states will step in and have their own credits? States like California, right, where you all have quite a number of customers and whose agenda might be more in line with, keeping those credits around?
Great question. We've always seen those changes happen. When there's federal changes, states do tend to make changes. But again, what we really see that what we do is so important, and it's an important part of our energy future now. And so we really see a very, clear path to providing that for Americans as we go forward. And again, of course, we're always looking at the existing language and how do we navigate if there aren't big changes made. But Again, I believe that as changes are made, as this travels through the Senate and makes its way to law, it will acknowledge the importance of those of us in the country that are providing important energy resources for the grid.
Mary, thank you so much. Appreciate your time today.
Thank you.
Now it's time for some of our trending tickers. We got our eye on Amazon, Cameco, those share prices rising, and Universal Health Services stock dropping. Let's start with Amazon. Those shares are going higher after the company announced a $20 billion investment in Pennsylvania. Pennsylvania Governor Josh Shapiro announcing that the digital retailer plans to build 2 data centers in the state, with one arranging to plug directly into a nuclear plant in the area. Now, these data centers are expected to continue to grow Amazon's cloud computing and artificial intelligence infrastructure. The latest announcements among a slew of new investments by the company around the country. So, and this isn't even the first one that they've had in Pennsylvania. It's just the latest. And remember, the company recently said it was going to invest $10 billion in North Carolina for AI infrastructure.
Yeah, it's remarkable, the numbers you're putting out. So plans to invest at least $20 billion in Pennsylvania to expand data center infrastructure. Sounds like Salem Township and Falls Township, those are the first communities identified as sites. It's going to create, they say, 1,250 new high-skilled jobs. And by the way, what's remarkable about that is, to your point, Julie, it was just last week on this show, we were talking how they were going to put $10 billion in North Carolina, which the governor, I believe, called that investment the largest in the state history.
I will say, I was perusing, which I'm always inspired by you. I was perusing the analyst ratings on this company, and something like 75 buy equivalent ratings. And just anecdotally, the tech analyst who we speak to, it seems like even among the tech giants, Amazon has sort of emerged as a favorite for many of them, not all of them, but for many of them, that's a name that surfaces again and again that has been a top pick this year.
Yeah, a lot of love on the street for Amazon,
for sure.
All right, we are also watching shares of Cameco skyrocketing after a company they own 49% of, Westinghouse Electric's, increased their EBITDA outlook for the next year. So Cameco, company saying, I guess on Friday, was that the share of Westinghouse adjusted EBITDA will rise $170 million from this one-time IP payment, and the analysts are out. They're taking out their red pens, making adjustments. TD Cowen, for example, hiked that target. Just one of many, a few here, saying reflecting the increased payment from Westinghouse, and said they expect higher multiples given positive momentum in nuclear.
Yes. So Cameco, a provider of uranium.
Yep.
Westinghouse, a builder of nuclear plants, among other sort of engineering services here. So as you mentioned, Cameco owns 49% of Westinghouse. Westinghouse got this one-time IP payment, but I will mention, just zooming out a little bit, 32% is the return, give or take, that Cameco has seen this year, and the stock's trading at a record high. We talk a lot about, we were just talking with Mary Powell about what we're seeing in terms of energy demand. We were just talking about Amazon, and where's that power coming from? As we've spoken a lot about, a lot of it, or at least some of it, is going to come from nuclear. And Cameco and Westinghouse both play into that. Apparently, the Financial Times reporting over the weekend that Westinghouse is in talks it will have some kind of role in the nuclear expansion plans in the U.S.
Yeah, I'm just looking. BMO looks like raised the target as well. The Westinghouse asset now expected to deliver a bumper Q2.
I'd like to hear that. Finally, ending on Universal Health Services, it's seeing its stock price fall following comments by that company's CEO at a conference, the Goldman Sachs Annual Global Healthcare Conference. UHS CFO Steve Felton saying the lengths of stays in hospitals are still longer than pre-COVID times. Other hospital providers like Tenet Healthcare seeing similar drops in their share prices as well. So that seems to be part of what's going on here. We also are still having concern in the industry about potential cuts to Medicaid payments. There was apparently a presidential memo on Friday that spoke to that. So analysts are also talking about that, which is still percolating through.
Yeah, one other headline I saw with United Health today, weighing multiple bids for its Latin American operations. This is according to Reuters, citing sources. It looks like, again, per Reuters, the company has 4 non-binding bids for that subsidiary, operates in Colombia and Chile for about $1 billion.
Gotcha. Yeah, a lot of uncertainty in the industry overall,
For sure.
though.
Warner Brothers Discovery, meanwhile, planned to split into two independent, publicly traded companies. The media company has separated its streaming and studio assets from its global television networks business. For more on how this reshapes the media investing landscape, let's get to Citi Managing Director Jason Bazinet. Jason, always good to see you. So let's start with that headline, Jason. I'm curious your reaction and your response. What'd you make of it?
Well, I think the buy side has been clamoring for some time for there to be consolidation among, I'll call them second-tier streaming apps. And I think with this decision to sort of split the company in two lays the groundwork for that to occur. In essence, the linear cable business that Warner Brothers had was almost like a poison pill. No one wanted to acquire more of those assets, and so it prevented the app and studio consolidation from occurring. So by having sort of bad co and good co, I think they've laid the groundwork for more media consolidation.
Jason, when will the media industry learn? I mean, come on. We have watched decades, right, of like consolidation, then a breakup, then reconsolidation in a different form. Has there been a successful media consolidation that has been consistently successful over time?
Well, no, but I wouldn't be quite so harsh on traditional media. And let me try and explain it this way. If you looked at Netflix's cash burn as they built this phenomenal business they burned cash for 10 years. And the street was more than willing to underwrite those cash losses. As traditional media embarked in consolidation following 2019, they sort of had a 2-year honeymoon period. When interest rates were low, the street was willing to underwrite losses, allow them to sort of build a scaled streaming business. And then the 10-year went up. And when the 10-year went to 4%, Wall Street changed their tune. They wanted profits. And what that meant is all the traditional media companies had to not stop spending as much building their app business. And so now they're all sort of half pregnant, right? They don't have the requisite scale to compete. They can't invest more in content to repeat the success of Netflix because the street won't tolerate losses. So now what this means is in this environment where these executives can't generate 10 years of losses, you need to consolidate to get more content under a single app.
Jason, why do you think WBD is down today? Stock's under pressure here. It's down about 4%.
Yeah, it's a little strange. I mean, I would say that everyone broadly agrees that they're probably going to generate about $1 a share by getting rid of the debt or tendering for the debt below par. But on the other side of the ledger that has people a little bit wigged out is there's some concern about dyssynergies. Because now you're going to have 2 legal departments, 2 finance departments. There's a little bit of concern that when they refinance all of this debt, it's going to come at a higher interest cost. And I think because the company didn't specify of the entire quantum of debt, how much goes on each piece, meaning the studio and streaming business or the linear business, people can't really fully complete their sum of the parts math. So those are the 3 main pushbacks I've heard from investors today.
Do you think that this is a good move, and are you still recommending investors buy the stock?
I do think I think it's an inevitable move. It's an inevitable move. But for investors that have a 3-month or 6-month or 9-month horizon, we're not going to see any sort of subsequent transaction, right? This split isn't going to occur until the earlier mid part of next year. And then I think in short order, you'll see the second round, the M&A actually occur. And that's when investors will get paid.
How, if at all, Jason, do you think the news today impacts the broader competitive landscape?
I guess if I was a streaming winner like Netflix, I wouldn't be overly concerned about this. I mean, I would describe this split, the consolidation that will happen, let's say a year from now, as a necessary but not sufficient condition to compete with Netflix. And Netflix will just continue to sort of deepen its moats by spending more on content, getting more subs, making the business more global. So it's not a good day if you're Netflix, but it's certainly not an existential threat.
Jason, thanks a lot for your perspective. I appreciate it.
Absolutely. Thank you.
Shares of IBM hitting all-time highs today and surpassing market cap of $250 billion for the first time in that company's history. We're going to dive into the latest moves on the other side as we give you the why behind the high. Stick around, more market domination still to come. The S&P 500 is once again approaching record territory, and investors are always on the lookout, not just for momentum within the indices, but with stocks that are moving towards records too. In that spirit, we'll be highlighting those companies that are at or near record highs. We're watching companies that have been outperforming despite the volatility we've seen this year. We'll be speaking with C-suite executives, analysts, and experts to bring you all the insights into the why behind the high. I'd like to welcome in Matthew Swanson to kick us off, RBC Capital's Director of Equity Research, to discuss one of the companies that is hitting a record again today. It's IBM. Matt, thanks so much for being here. This feels a little bit like an under the radar or kind of a stealth one, right? IBM, obviously a tech giant, but it's not in the so-called Magnificent Seven, right? Yet here it is hitting a record. So I guess just high level, give us kind of what's going on here that's been propelling that recent growth.
Yeah, and thank you guys so much for having me. I think with IBM, it really started off as a free cash flow story. When we look back about 5-6 quarters ago, going into Q4 when they had the big beat, that was kind of the start of the rally. But you mentioned it not being part of the Magnificent Seven. I think they're really starting to make their name for being able to enable the Magnificent Seven, right? They talk about the core pillars being hybrid cloud and Gen AI, but a lot about that is being in the infrastructure layer. Really, how do we make all of this work? And they're uniquely positioned to do that by leveraging both infrastructure and consulting with that growing software business that they're starting to get some more recognition for.
And of course, when they last reported earnings, the stock actually initially fell because the numbers weren't quite strong enough to meet some lofty expectations. And since then, obviously, we have seen a rebound. When you look forward at what growth is expected, you look at revenue growth in the out years, it's expected it will show kind of low to mid single digit revenue growth, which isn't huge. So is that enough to continue to propel the stock higher?
Yeah, well, maybe touching on the quarter real quick.
Sure.
A lot of times we try to break down these complicated businesses into some of these key metrics. And I think it was Gen AI bookings, free cash flow, and then Red Hat, which is kind of that center of gravity for their software business. And two of the three were below at least kind of consensus expectations. Free cash flow is the outlier to the positive side. So when we look to the future, I think a lot of it, they pegged that 5% growth rate as kind of what they're looking for, but it's going to be just as much about how they get it than if they get it. So software growth definitely is the number one thing that investors are focused on. You follow that with the Gen AI side of consulting. And then infrastructure, obviously going to be much more refresh dependent. So a lot of this valuation and the current sentiment is really coming down to just how does that software business performs.
And to dig into the Gen AI piece of it a little more, obviously on overall AI and sort of machine learning, IBM had Watson and sort of was a pioneer there. Where do they play in that world, not from an infrastructure perspective, but that actual product, right? What's the role that it plays now in terms of the company's growth?
Yeah. And I think one thing to always to point out is from a book of business standpoint, we're still at about 80% consulting, right, for Gen AI, which means that they're not only helping people deploy all this, but they're seeing all the trends, seeing all the choke points. And they're really starting to talk a lot more about this idea of client zero, which is about how IBM themselves have saved $3.5 billion in run rate costs at the end of last year by deploying Gen AI. So if you talk about what are they really doing from a product standpoint, their own series of models, the Granite models, would be what we would call a small language model. It's open source. You can move from OpenShift AI to Watson XAI once you're fully deployed and actually build up your own IP on those smaller models. They're really focused around the enterprise cost efficiency of running those models. And then the other side of that, I know you said not on the infrastructure side, but we got to touch on it a little bit, is these things like Watson X Governance and Watson X Orchestrate. And those two things are really about managing the basically practical implications of having Gen AI run in your environment. How does the data get accessed? How does it not get accessed for areas that you don't want it going? And then how do you keep track of all these different models and how they're interacting with each other?
Matt, I also want to ask you about quantum, because you wrote about this in your latest note, saying that IBM could be a stealth quantum play. Now, quantum is confusing, right? Because you hear on the one hand that we're sort of years away from it having practical applications, but then you see it that some companies like IBM are already making money from it. So help explain that for our viewers.
Yeah, and I think one of the reasons IBM started talking about it is that it is starting to come up so much more with some of these other companies coming up in the space. And it's also coming up more for investors, talking to people like me. And so we addressed it at IBM Think. And the way they kind of pointed it out is they have 75 quantum computers, 13 of them are currently running at production. And they feel like this will be a real part of their business by the end of the decade. And I think that by the end of the decade was the part that really surprised a lot of people in the room. Because like you mentioned, quantum has felt like it's been a story for quite some time, but it's never felt really tangibly real. And I think we're starting to get to the place that the costs are coming down to a point where we can have commercial applications beyond some of these early adopters like biotech.
Finally, Matt, I'm curious what you think the biggest risk is, or risks for the stock going forward that might disrupt this trajectory it's been on.
Yeah. When you talk about risks from a stock specific perspective, and it's kind of when you look at how the stock came up too, right? When you have 62 billion in revenue, it's hard to really get that big of a ship moving fast in one direction in terms of accelerating growth to have numbers go up that way. But the multiple expansion comes around sentiment. And sentiment right now is really improving around those core use cases of Gen AI and that core use case around hybrid cloud. So I think if we saw a change in their competitive positioning, particularly as it pertains to Gen AI, where I think people see this as a safer way to play the underlying part and not have to make a bet on who's going to win at the actual large language model level, I think that would be where you could see the most risk from a re-rating happening.
Matt, thanks so much. Appreciate it.
Thank you.
And all this week, we'll be continuing to shine a spotlight on companies at or near record highs. Be sure to tune in to hear from CEOs of Trane and NRG Energy, along with the CFO of Waste Management, all part of our segment, The Why Behind the High. In the meantime, we'll be wrapping up today's Market Domination, but don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.